Hi, it's Ryan Harris here with HomePad Lending, coming to you to give you guys some tips on the home buying process and how the whole process works from kind of start to finish. I'm going to go over kind of generalized timelines and such. Your transaction may be different depending on the professionals that you work with and the aggressiveness of the market and seller demands, and there are plenty of other factors, but this is kind of just a general overview of the entire purchase process. The first thing you want to do, obviously, when you go to purchase a home or even consider purchasing a home is to get pre-qualified. Now, what a pre-qualification entails, you're going to have a verbal conversation with the lender. The lender will look at your credit. They will verbally discuss your income as well as down payment requirements that you'll be required to make in order to meet loan guidelines. Assuming the pre-qualification process looks good, then you'll move to a pre-approval. The pre-approval requires you to actually submit your financial documentation, so bank statements, pay stubs, W-2s, or if you're self-employed, you might have to submit tax returns, 1099s, K-1s, and business returns as well. So it just kind of depends on what you've got going on, but you'll actually submit your financial documentation. The loan officer will then verify that information that they've entered into the system matches the financial documentation that you've provided, and then you'll be what's called pre-approved. Pre-approval is the first step in actually moving forward to buying a house, because it ensures that a loan officer has reviewed your financial credentials as well as reviewed a copy of your credit report, and they can verify that you actually qualify for the loan program. The loan still typically has to be underwritten by an underwriter, and some companies may go to that extent if they're unsure about your qualifications. But for the most part, the pre-approvals are generally reviewed by the loan officer. Once you're pre-approved, then you can actually begin the home search. You really don't want to begin with the home search prior to that, because you may be looking at homes that are outside of your price range or what you may be able to afford in the eyes of the bank or what the bank is willing to lend you. So, and you can see a lot of disappointment with that, because if you're looking at homes that maybe are $100,000 or $200,000 outside of your price range, resetting your own expectations internally can be really, really difficult if you've seen those higher end homes and you're expecting those features to be in the lower priced homes. So get pre-approved first. From there, we always recommend working with a real estate professional. Get a recommendation from your loan officer or friends and family. But you want to select a real estate agent and use them for the transaction. The reason for that is they're going to have access to the most up-to-date and accurate market data. So they're going to be connected to a regional listing service that's going to provide access to the listings in the area, and the listing data updates in real time. If you're out there just messing around on a Zillow or Trulia or Redfin or any of those consumer websites, those databases are national databases, so they don't update as quickly as a regional database that the real estate agents are going to have access to. The other thing is the real estate agents can filter the results down a little bit more and have the listings that meet your criteria spoon-fed to you via email as soon as they come on the market. So it's a huge benefit and a competitive advantage to use a real estate agent, because they're going to have access to better housing data, and as fast as that market moves, that is going to give you an advantage when you're searching for a home. Once you've found a home, you've viewed the home, and you've decided to make an offer, then you'll work with your agent to put together an offer. Most of the offers are going to be signed electronically. They're submitted to the listing agent via email. The listing agent is the agent that's representing the property. Once the seller agrees to accept the offer that you've made on the property, then you actually begin the actual loan process. Once you have a home under contract, that's the point where you're typically going to lock in an interest rate, and the loan officer or loan company will send you loan documentation that's going to outline the loan terms that you're actually qualifying for. During the first 10 days of the contract, typically it's a 10-day inspection window. That's kind of standard. It may be shorter, maybe longer, depending on your market and what you've negotiated in the contract. Everything is really negotiable when you're out there making offers on homes. But typically you're going to have 10 days to inspect the property. You'll get a home inspector to go out to the home, make sure the house isn't sinking into the earth and falling down, and there's issues that you're not going to see as a consumer, because you just don't do this all day. Most people have normal jobs that don't revolve around housing. They work in business environments, so they're not familiar with houses sinking and various other problems that come up with homes in the area. You complete the home inspection, you negotiate any repairs with the seller during that that initial 10-day period. As soon as that's completed, you're going to want to order the appraisal. The reason you don't order the appraisal at the same time as the home inspection is because if something happens with the home inspection, you don't want to be on the hook for the cost of the appraisal as well. Home inspections are typically $500 to $1,000 depending on the scope of the job and the size of the home and various other factors. You want to get a quote from a professional in order to really hammer down that price. Appraisals are kind of hovering in I would say 600 is pretty average right now, but it can be, I've seen as high as 2,000 in certain markets and obscure areas. It really depends on supply and demand in that particular area and how many appraisers are available. Once you've signed everything and submitted, you should have already submitted your financial documentation with your pre-approval. The loan would go to underwriting. The underwriter would approve it. So about the time you're ordering the appraisal, you should be submitting your first set of underwriting conditions if you have any underwriting conditions. So maybe your bank statement, one of the pages was cut off, or a pay stub was cut off, or a W-2 was cut off, and you have to resubmit something like that. Small little clerical fixes. You'll then correct those right about the time you're ordering the appraisal. Then you're just kind of waiting on the appraisal to come in on the property. Once the appraisal comes in, the lender should be buttoning up the title on the property with the title company, making sure that the title commitment is clean and the property can be transferred into your name without any previous title holders coming after you. And then you're going to finalize your homeowners insurance at that point. So, Farmers, Geico, State Farm, whoever you're using for that, you're going to finalize that insurance policy that's going to insure that home against natural disasters. Once you obtain the finalized homeowners insurance and the title's all squared away, you'll submit the remaining items along with the appraisal back to underwriting, and they'll do a final kind of check through or sign off on the entire package. And you'll have what's called a clear to close. So clear to close just means there's no underwriting conditions left on the loan and there's nothing left for you to provide as a consumer. From that point, they're going to start prepping your documents for the loan closing and then start coming up with the final figures on what's going to be due at closing, and you'll get a better idea of what your actual final cash to close is. You should have a good solid estimate up to this point, but exact numbers are never going to be like dialed into the penny until you get within just a few days of the actual signing itself. From there, you'll schedule signing, and the loan will typically fund and record within 1 business day or 24 hours. That really varies based on the county and the title company that you're using for the transaction. Sometimes there's companies that require to use out-of-state title companies, like some of the offer pads and open doors, so that can add an extra day or so to your signing because the documents have to be mailed out of state. There's a bunch of different factors, and that's why it's important to work with professionals that understand all this and can set these expectations with you, so you don't have movers showing up 5 minutes after you sign your loan documents, because it may take a half a day or even a full day or even 2 days for the loan to fund and record. Once the documents and everything are recorded with the county that the property is located in, then you're actually considered the owner of the property, and that's when they can give you keys to the home. Once again, these are very generalized guidelines or generalized explanation of the entire process. So your expectations should be set appropriately based upon the professionals you choose to work with. We make it our point to do that, obviously, on every single transaction because everything's different. It's all very negotiable. But these are just general guidelines on what you're going to see. If you guys have any questions, obviously feel free to reach out and like and subscribe. Thanks again.